When you imagine the white-knuckle, adrenaline ride of the modern stock market, it's difficult to imagine it was ever anything but a room full of red-faced, middle-aged men screaming at a price chart. The truth is, the stock market has a rich and colorful history spanning over 400 years. From its early days sandwiched between Dutch brothels to the emotion-packed halls of Wall Street at the end of the 20th century, the stock market has a story to tell. Welcome to Investor Junkie, your guide to wealth creation, money moves, and market opportunities. Subscribe now for the latest videos, our free Investor Junkie newsletter, and regular updates on the latest in investing trends. So, when and where did the stock market first originate? The Spice Rush. To answer that story, we gotta go all the way back to July 1497. Portuguese explorer Vasco da Gama had just discovered a sea route from Portugal that traveled down around the Cape of South Africa and back up to mainland India. This contact between Europeans and the Indians of the subcontinent would eventually kickstart one of the largest trade relationships in modern history, spawning the creation of the biggest corporation to ever exist. India was and still is a country rich with spices, silk, textiles, and unique craftsmanship, things that were completely foreign to 14th century Europe. This created a lucrative market that everyone wanted a piece of. Fleets of trading ships from Spain, Portugal, and the Netherlands began carving out sea routes and setting up trade hubs along the East Indian coast of Kerala. So adored were Asian spices that for a while there, pepper was worth twice its weight in solid gold. You gotta hand it to the early Indian spice traders though. For over 100 years, they kept the secrets of how spices like black pepper, nutmeg, and cinnamon were cultivated. They would invent fanciful tales of how certain spices were gifts from the gods or divinely acquired. After all, the spice trade would be over the second Europeans figured out they could just grow ginger and turmeric at home. The spice rush would only ramp up during the 16th and 17th centuries before the Dutch quite literally put their stamp on the entire industry. Holland was a hotbed of economic and political activity through the Renaissance, and at the turn of the 17th century, the Dutch government ordered several rival trading companies to consolidate and merge into a single entity. Until that point, the spice trade was a bit like the Wild West. Piracy, theft, and mutiny were commonplace, and different merchants were given different rates based on their relationship with the Mughal traders in India. This forced consolidation was an attempt to modernize the trade route while also monopolizing supply and distribution. The result was the Dutch East India Trading Company, also known by the Dutch anagram VOC, the world's first ever vertically integrated global supply chain. Within less than a couple years, the VOC was responsible for supplying much of Europe with spices, silks, coffee, and sugarcane. As a part of the Dutch East India's charter, the government drafted a revolutionary process to raise funds for the company's expansion, inviting all Dutch citizens the opportunity to invest in the VOC. In fact, Article 10 specifically says that all residents of the land must buy shares in this company. There would be no minimum or maximum share allocation. Does this kind of capital raising sound familiar at all to you? It should, because this would be the first ever example of an IPO, or initial public offering. The merchants that were forced into this merger were already successful businessmen, and evidence of their wealth in downtown Amsterdam was very apparent. This inspired confidence in the IOP, and Dutch citizens initially flocked to the home of the VOC founders to swap cash for shares in the company. But that sentiment didn't last long. Under the initial charter, any shares purchased would be locked up for a period of 21 years. Later reduced to 10 to promote more participation. Now, keep in mind that the VOC wasn't just a trading company at the time. They were actively fighting against the Spanish Empire for control over the trade routes. While modern companies worry about hostile takeovers and market changes, the VOC had to wage a literal war to stay afloat. You wouldn't invest in a company that's quarterly statements included a death count, would you? This unfortunate situation led to a lot of hesitancy amongst new investors and nervousness amongst those who had already purchased shares. To combat this, on August the 1st, an extra provision appeared on the charter stating that conveyance or transfer of shares may be done through the bookkeeper of this chamber. And with that one-sentence amendment, the first provisions for the first ever share trade was born. By August the 31st, 1602, 1,143 people had invested in the Dutch East India Company, raising a total of 3,674,945 Dutch guilders. To put this kind of money in perspective, a few hundred guilders at the time could purchase a small home. This absolute fortune was raised despite a plague outbreak in Amsterdam the same year that forced the majority of the population to flee the cities. Now, although the trading process was formalized, there was no stock exchange building to conduct the shares. Shares were bought, sold, and swapped in open-air markets along Amsterdam's New Bridge. If weather was bad, traders crammed into the historic Uitkerk to escape the rain. It wasn't until 1611 that architect Hendrik de Keyser was commissioned to design and build the world's first ever stock exchange. Nestled between Amsterdam's Dam Square and the infamous Red Light District, the Hendrik de Keyser Exchange stood as the world's first stock exchange for over 200 years. While commodities and goods were traded at the front of the building, share trading took place at the rear of the building. It was here that the iconic ringing of the bell was first performed, a ritual that denotes the start of the trading day. While it may have evolved into the gong in more modern times, the busy halls of the Dutch Stock Exchange is where it all began. So, how did early investors of the VOC IPO fare financially? Well, unlike the data-driven days of the modern stock market, record-keeping in the 1600s wasn't always amazing. Neither the exchange clerk nor the VOC itself recorded the prices regularly, and the share price chart you're looking at represents share price observations found in letters, deeds, and newspapers. Despite the spotty data, initial investors essentially saw 3 to 5 times return on their shares in the first 40 to 50 years of trading. Added to the fact that from 1623 onwards, the VOC began paying regular dividends to its investors. The creation of the first stock exchange ushered a new age of prosperity in the Netherlands, known colloquially as the Dutch Golden Age. With the world watching how profitable this new business model really was, other countries would soon follow suit with their own stock exchanges. While France did toy with the rudimentary stock exchange as early as 1540, it wasn't until 1724 that the Paris Stock Exchange was formed by order of the Royal Council of State. The early selling floor was vastly different than it is today. For example, until 1967, women weren't permitted anywhere in the building, and from 1774 until very recently, market officials were required to shout out market prices, leading to the familiar open outcry term. So, with share trading gaining momentum in Europe, it was only a matter of time before the concept moved to the United States. In March of 1792, 24 of New York's wealthiest merchants conducted a secret meeting to discuss how to set up security trading in the United States. 2 months later, they would all sign a document that would eventually become known as the Buttonwood Agreement. Considered the most important financial documents in the history of the United States economy, the Buttonwood Agreement outlined things like who brokers had to deal with in order to conduct a trade and what kind of commissions were appropriate for trading activities. The Buttonwood Agreement was also instrumental in shaping the American stock market. The date of its signing would later be considered the founding date of the New York Stock Exchange. These 24 merchants continued to meet after the agreement, conducting their business in a New York coffee shop on the corner of Water and Wall Street. Running 8 blocks down Lower Manhattan's financial district is the economic region known as Wall Street. It's home to both the New York Stock Exchange and the NASDAQ, which operates 3 additional exchanges, including America's oldest stock exchange, the Philadelphia Stock Exchange. Despite the eye-watering amount of money that passes through Wall Street, it wasn't always a highbrow avenue for trading stocks. Throughout the 17th century, Wall Street existed as an open-air slave market as well as a hub for economic activity. And while the New York Stock Exchange was founded in 1792, it wasn't until 1817 that it was formally instituted and given a name. Today, there are 13 active stock exchanges throughout the U.S. with a total market cap of more than $51 trillion. representing more than 55% of total world stock market cap, which today sits around $95 trillion. Now, while overall stock market prices have been trading upwards since the inception of the stock market, we have been interrupted by some very hard crashes over the centuries. The first of those was called the Great Depression. No, we're not talking about your late 20s. The Great Depression actually refers to a decade-long period of economic downturn from 1929 to the end of the 1930s. On October 24th, 1929, on a day forever known as Black Thursday, U.S. markets suffered a catastrophic crash, with the entire market losing 11% of its value in a single day. The following week starred Black Monday, followed by Black Tuesday, where similar drops were recorded. The panic selling and capitulation that followed resulted in the Dow losing up to 89% of its value from its peak just months earlier. In fact, so severe was the crash that it affected global markets and sent unemployment figures soaring up towards 30%. Every financial market around the world, all except Japan's, were crippled for years. It was at this point that stock markets around the world instituted measures to suspend trading in any event of extreme volatility. These measures included trading curbs or circuit breakers, which prevent any trade activity whatsoever for a certain period of time following a sharp decline in stock prices. And while the Dow began to recover as early as 1933, it wouldn't return to its previous all-time high until November 1954. Fast forward half a century, and these safeguards did nothing to prevent a whole new threat. Beginning in the early 2000s, consumers globally noticed an exorbitant rise in asset prices. This was mirrored with an emerging financial crisis in the U.S. surrounding the subprime mortgage sector. In 2006, the U.S. housing bubble burst, sending hundreds of thousands of Americans to default in their mortgage payments. Suddenly, U.S. securities that were backed up by subprime mortgages began collapsing in value, causing a panic in the interbank loan market. Banks, financial institutions, and investment firms began incurring massive losses, causing insolvencies, bankruptcies, and widespread government bailouts. By 2007, this financial crisis had gone global, triggering a sharp drop in international trade, rising unemployment, and slumping commodity prices. In response, many governments began various economic stimulus strategies to try and jumpstart the economy. When the U.S. Congress initially rejected the Emergency Economic Stabilization Act of 2008, it crashed the Dow by 777.68 points in a single day, the biggest point drop in history up until then. By March 2009, the Dow had dropped more than 50% of its peak in 2007, only to start recovering by July 2009. Despite the crashes and recessions we've seen over the years, the stock market continues to outperform almost every other investment option on average, and has consistently done so for hundreds of years. We've come a long way since yelling out prices on a Dutch bridge in earshot from the red light district. As technology, transparency, and access to real-time data improves, so too will the robustness and profitability of investment options in the stock market. That's all we have time for on today's video. I hope you learned something. If you liked this video, please remember to hit that like button. And if you want to see more content just like this, make sure to subscribe to the channel with the notifications enabled. Thanks for watching, guys, and I'll see you on the next video. Investor Junkie.